Welcome to another FAR walkthrough video. I'm Logan, and in today's video we're going to be talking about preparing a statement of changes in equity, and we're going to be doing that the SuperfastCPA CPA way, which is diving straight into questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training where we teach you the key ingredients to passing the CPA exam. Again, it is only 1 hour, it is free, and we will teach you how to be effective and efficient with your studying so you don't waste months or even years of your time. The link will be in the description, so make sure to check it out. Also, we will only be going over 5 questions in this video, whereas SuperfastCPA members will have access to the full 10-question video when we post it in the members forum, so if you like this, you can get more of it by becoming a SuperfastCPA member. With all that said, let's dive straight into the questions. Alright, here we are at question 1. Which of the following items are typically included in a statement of changes in equity? Okay, so you may not have heard too much about the statement of changes in equity because I feel like it kind of gets overshadowed by the balance sheet, the income statement, the cash flow, things like that. But this is basically what it says. It's just what the changes were in equity and how you figured out what the ending equity was. So what of these things would impact equity? If you have any experience with accounting, then you might know. If not, that's okay. Let's dive straight into the answer to learn what affects equity and what the statement of changes in equity is. All right, the answer is A, net income, dividends declared, and changes in retained earnings. And of course, there's more things, so we'll talk about that. But these are some things that affect the statement of changes in equity. So let's read through this. A statement of changes in equity, also known as the statement of shareholders' equity, so that might be a name that you've heard before, is a financial statement that shows the movement in equity accounts over a period. It typically includes net income or loss, and of course that's the profit or loss generated by the company during the period, which affects retained earnings. So that's the reason that we're talking about it, is because it affects the retained earnings, which is also kept track of in the statement of changes in equity. Dividends declared, this represents the distribution of profits to shareholders, which reduces retained earnings. Changes in retained earnings, so again, we've already talked about a couple changes. This includes the opening balance of retained earnings, adjusted for net income or loss, and dividends declared, resulting in the closing balance of retained earnings. So these first three, really it was just talking about retained earnings, which is a big part of the statement of changes in equity. And then there's other comprehensive income. This includes items not recognized in the income statement, such as unrealized gains or losses on certain investments and foreign currency translation adjustments. We just talked about those things in the previous videos. So this is something that flows into the statement of changes in equity. And then of course there's share capital, which is the changes in the common and the preferred shares issued by the company. You've probably heard that, common shares, that's a part of equity. And then treasury shares. This shows the purchase or sale of the company's own shares. So that's a reminder, treasury shares are basically the company purchasing back its own shares. The statement provides a detailed reconciliation of the beginning and ending equity balances, offering insight into the factors driving changes in the shareholders' equity during the reporting period. So basically, it's just taking a very close look at the equity section of a balance sheet, almost like a big zoom in. And that's what the statement of changes in equity is. You're taking into account all of these things that affect equity, and then you get the ending equity for the year. So that's what we're going to be talking about throughout the rest of this video. This was a good intro question. Let's dive into the next question. All right, here we are at question 2. Given the following information, calculate the total ending equity. So we just talked about all this, but now we have to actually take these numbers, the retained earnings, the net income, the dividends declared, all these things, and figure out what the ending equity is. So based off what we just looked at before and your experience in accounting, you probably could pause the video and do the calculation. But if not, if you don't want to do that, that's okay. We're going to dive straight into the answer. But if you do want to try, go ahead and pause the video right now and come back when you're ready and we'll look at it together. All right, here we are at the answer, $223,000. So let's read through this explanation. To calculate the total ending equity, we need to sum the beginning retained earnings with net income, subtract dividends declared, add the issuance of common stock, subtract the repurchase of treasury stock, and add any unrealized gains on available for sale securities. So here's the step-by-step calculation. We start with the beginning retained earnings. We add the net income. That gives us $200,000 in retained earnings. And then we subtract the dividends declared. That was $10,000, so that gets us to $190,000 of retained earnings. And then we also, for the total equity, add in $30,000 of common stock because they issued more stock. That means that increases the equity. So that's $220,000 right there. And then we subtract the repurchase of treasury stock. So this is a decrease in the equity. So that leaves us with $215,000. And then we add the unrealized gain on available for sale securities. That was $8,000. And that gives us $223,000 of total equity in the end. So these are some of the things and how they affect the equity. Dividends declared, you're giving money out to shareholders, so of course your equity is going to decrease. But if you issue more common stock for more money, that's going to increase it. Buying back your own treasury stock, that's going to decrease your equity because that's no longer out there on the market. You repurchased it. And then, as you'll notice here, this was a component of other comprehensive income or accumulated other comprehensive income. So that is something that is added to equity that we've been talking about, but now we see how it affects the balance sheet. It's added to equity. So that was a good calculation problem. Let's go to the next question. All right, here we are at question 3. Given the following information, calculate the ending retained earnings. Retained earnings is a big part of equity, so I figured we could do a question specifically about retained earnings. So we have to take all of this information that's given us and figure out what the ending retained earnings is. It's giving us revenue, a whole bunch of expenses, it's giving us the original retained earnings before incorporating anything else, and it's giving us dividends declared. So it's not too difficult if you know how to do an income statement and how retained earnings works, and you probably do because you're in accounting, but if not, that's okay. Let's go ahead and have you pause the video, see if you can do the calculation and get the correct answer, and when you're ready, come back, we'll look at it together. All right, the answer is D, $310,000. So as you probably guessed, we have to figure out what the net income is so that we know how that affects the retained earnings. So first we have to calculate the net income. That was the sales revenue less the cost of goods sold, less the operating expenses, less the interest expense, less the tax expense or the income tax expense. That gets us to net income of $135,000. And then we add that to the beginning retained earnings, and that gives us $335,000, but then we subtract the dividends declared, giving us $310,000 of retained earnings. And again, this is important to know how to do because this is a big part of equity. So if you don't know how to calculate the net income and then how that affects retained earnings, then you're not going to have the correct retained earnings and you're not going to have the correct ending equity on your statement of changes in equity. So make sure you know how to do this. Let's go to the next question. All right, here we are at question 4. Given the following transactions, what are the total credits to equity? So this is kind of coming at it from a actual accounting standpoint, the journal entries. Which of these would be credits and which would be debits so that we know what the total credits to equity are? So we have issued common stock for cash, and that includes the par value and also some additional paid in capital. We have declared dividends, we have net income, we have repurchased treasury stock, and we have unrealized gain on available for sale securities. We've been talking about these things, and we've been talking about some of them increasing and decreasing equity, but how does equity work? Is it increased by credits? Is it increased by debits? Just remember the accounting equation, but again, if you don't know how to do it, that's okay. We're going to go straight to the answer. And the answer is B, $97,000. That's the total credits or increases to equity. So just remember that equity is credited if you want to increase it, and you credit common stock at the par value, and then there was additional paid in capital, you also credit that. So that's $50,000 right there of credit that's going to increase the equity. But dividends declared and paid, that's a debit that decreases equity, so we don't include that in for this question. Then there's the net income, that's a credit that increases equity, so we include that. Repurchased treasury stock, that's a debit because that again decreases equity, so that's $5,000 that we don't include in this question. And then finally, the unrealized gain on available for sale securities, that's credit because that's a gain that increases equity, so that's $7,000. So we take all that, the $10,000 of the common stock at par value, plus the additional paid in capital or APIC, the $40,000 of net income, and then $7,000 of unrealized gain. These are all credits. These are all things that increase equity. So make sure you remember how equity is affected. Remember, the accounting equation is assets equals liabilities and equity. So most equity and most liabilities, of course there's some things that are contra, but most liabilities and most equity are increased by a credit and decreased by a debit. And it's the other way around for assets. It's increased by a debit, decreased by a credit. And of course, like I said, there's contra accounts, but that's the general rule. So remember that for equity, you increase it with credits. So anything that increases equity, if you were doing the journal entry, it would be a credit. All right, let's go to the next question. All right, here we are at question 5. At the beginning of the year, Blue Horizon Inc. had total assets of $800,000 and total liabilities of $500,000. During the year, the company issued common stock for $70,000 and earned a net income of $100,000. They declared and paid dividends amounting to $30,000 and repurchased treasury stock for $15,000. Additionally, they recorded an unrealized gain on available for sale securities of $8,000 and a foreign currency translation adjustment loss of $6,000. So with all that information that we just read, what is the total ending balance in equity? We've talked about this throughout the whole video. It's not too difficult once you know what affects equity and how to calculate it. So you could probably do it. Pause the video, do the calculation yourself, and when you're ready, come back. We'll look at it together. All right, the answer is B, $427,000. So let's go through this. To calculate it, first we have to figure out the beginning equity. This wasn't given to us, but again, it's not too difficult. We just talked about this. Assets equals liabilities and equity. So we subtract the liabilities from the assets, and that gives us the equity, $300,000. Now we have something to add all the other equity accounts to. So we add the issued common stock, we add the net income, we subtract the dividends declared and paid, we subtract the repurchased treasury stock, we add the unrealized gain on available for sale securities, and we subtract the foreign currency translation adjustment loss, all to the beginning equity, which was $300,000 again. So all that together, $300,000 plus $70,000 plus $100,000 plus $8,000 less $30,000 less $15,000 less $6,000 gives us $427,000 of ending equity. So this one was a little bit tricky, but again, it's not too difficult if you remember the accounting equation. You might have to sometimes figure out what the equity actually is at the beginning of the year because it might not be given to you, but it's not too difficult a lot of the time because you can just subtract liabilities from assets. And with that, we've gone through 5 questions. We've learned a lot in just 5 questions. So before we go any further, let's do one more part of the process called pillar topics. Now, the idea behind pillar topics in the SuperFast CPA strategy is as you're going through the questions to learn the material, you will notice patterns, you will notice equations and topics that keep popping up throughout the questions. These are the things that you've seen multiple times, and you know they are important because, again, you've seen them a whole bunch of times throughout your studying. So you take a second, write them down in your own words so that you know them and have them as pillar topics for later. So let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. And first off, what are the components of the statement of changes in equity? This statement includes net income, dividends declared, which really is just the changes in retained earnings, and then of course it includes retained earnings, other comprehensive income, share capital, and treasury shares. So all of those things that you typically think of when you think of equity, that's what it's looking at for the statement of changes in equity. To find the ending equity, we start with the beginning equity, pretty simple, and then we adjust it for those things we just talked about. We adjust it for the net income, the dividends declared, issuance of stock, repurchase of treasury stock, comprehensive income items, and as far as how equity it looks, you increase it with credits, and so that would be a credit of net income, a credit of issuance of stock, but you would decrease it with debits. So that would be a debit of dividends paid or a debit of repurchases of treasury stock. And then finally, accumulated other comprehensive income. We've talked a whole bunch about other comprehensive income in the past couple videos. That includes items like unrealized gains or losses on securities and foreign currency adjustments, and is a key part of the equity section of the balance sheet. So AOCI, accumulated other comprehensive income, is where all other comprehensive income flows into, and then that is shown on the equity part of the balance sheet, or it's shown in the statement of changes in equity. And with that, those are the pillar topics for this video. Before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Again, it is only 1 hour, it is free, and we will teach you how to pass the CPA exam without wasting months or even years of your time. We only went over 5 questions in this video, but if you liked it, just remember that Superfast CPA members have access to the full 10-question video once we post it in the members forum, so you can get more of it by becoming a Superfast CPA member. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.